Welcome back to Halftime Report on CNBC-TV18. Now, TCI Express, that reported its Q1 numbers. A muted set that came in from the company, and the revenue declined for the 7th consecutive quarter. Now, what does it mean for the company going forward? What are we watching out for, especially in terms of this GST rationalization that's come in as well, plus the outlook of the company going forward? We do have Mukti, CFO at TCI Express, joining in with us to give us those details. Hi, sir. Good afternoon. Thank you so much for giving us your time. Let's start by talking about the numbers first. Revenue this time, again, a muted quarter that's coming from the company, right? So what are we watching out for now in terms of the overall growth guidance that you all have given? 11 to 12% is what you all spoke about. Will you all be able to achieve that for FY26? And anything in terms of growth drivers that are there for the company for this year?
This quarter we also anticipated like flattish quarter, and it was on the same way. And in this year, we targeting kind of like 8%, 9% volume growth and 11% revenue growth. So this is basically, we are targeting enhance my rate increases with the customer, which we did already in Q1 around 50 basis point. And this way, as also we have strategized to be enhancing our multimodal businesses also, which includes Rail Express, C2C, air, domestic and international. So these will also help us to be grow faster than our, business. A major chunk is coming from surface business. So we also enhancing this businesses on a fast growth. So ultimately, interestingly, one thing happened where we're seeing more stability in comparison to last year. We have more predictability, like we have seen in last year. We predicted something else, and then volumes has not come on that way. But in this year, macros of economies are, I think, really in a well position, and like inflation is under control, and people now buying the more things.
Right. So then that 11 to 12% will be sustainable in terms of revenue growth.
Yes.
Your guidance for the full year. And volume growth also, you will be able to manage it at 8 to 9% that you've spoken about, right? So expecting a recovery now coming in Q2 and onwards, you're expecting much better growth.
Yes, that's absolutely.
Okay.
Mr. Lal, just while you are quite bullish in terms of the guidance, what is the demand scenario looking like, considering that your revenue was down for the 7th consecutive quarter in terms of sales?
Yeah, so if you see, like our revenue is down almost like in a range of 2-3%. So there is no structural kind of thing. It is like matter of economies is not growing well where we operate in. So segments like, continuously engineering segment, lifestyle products, they still are like under flattish kind of growth. This is not improving due to private capex has not taken up yet. So these are the basic scenario where we not improve that. That's why one of risk is there. We have only one line of business in our company, and that's we want to be de-risk this line of businesses. That's why we added similar kind of other express services as a multimodal. So these will also be help wherever supposing one business is not doing well or one's line of service is not doing well, then other has to be support. So that's why with this strategy we going to be improved in time to come, and certainly we create a network for these services also. We also added the branches. So I think we will be in a better position in this year.
Okay. So I just wanted to narrow down on the margin picture, because you've done sub 10% margins for the past 3 quarters. You are targeting 15 to 16% for FY26, FY27. Is that correct?
So we targeting, in the range of 14 to 15%. So basically why I am so bullish on this margin improvement, because our margin has declined in last year due to we created a network for our multimodal products. And there is some issues in, like we face the inflationary challenges in toll and labor costs. That has a very good news here. We already stabilized the cost, which you seen in a Q1 results also. So this will be help us to be improve our margin, because once we get the volume, it is directly add to our capacity utilization, which is hovering around 82%. So whatever we add, that will be directly add to our margin, which we also did in FY23 in the range of 15%. So we'll be back to normal, because there is nothing change on that side. Rather, we in a spree where we want to be improve and pass on to customer. That is also a planning to we have at least 200 basis point to customer, because now an overall macro situation of economy is positive. Customer is also responding to accept the price increase and all. So this way will be certainly move towards 14 to 15% in this year.
Sure. Also, just talking about the C2C segment for the company, as well as at Surface Express, where you're focusing a lot more, that seems to be fructifying in terms of growth. Do you think that growth is going to be continuing for the Surface segment, as well as, in terms of the C2C segment as well?
Yeah, so, Surface is our key segment where we generating almost 83% revenue on overall basis. So that is also always in our key strategies to improve that. And now, again, as I said, to de-risk of that, that's why we want to be added these other services. Those is like completely Surface Express would be continue to the key growth driver for us, because here we already like de-risk in, because we doing various segments, we serving various segment in Surface also, and also de-risk in terms of big customer and small customer. So good news here, like SMEs also started to be improve the businesses due to lower inflation and slightly stable labor cost, and there is nothing I think is disrupting things we seeing in a near future for these SME customers. So hopefully this will be help to grow this simultaneously, but we want to be slightly more growth in multimodal products. So like we will be growing Surface in the range of 8-9% in revenue terms, and multimodal we can be grow in the range of 14-15%, which we given the number in Q1 also, where in C2C we grown almost 14%, air international we grown almost 30% plus. So this will be help to make the things in balanced.
Okay. Just before we let you go, there are a lot of uncertainties right now with regards to the tariff situation. We also have the GST reforms which could come through by Diwali. So give us a sense in terms of how these two parameters are probably playing out for your business as a whole, where the tariffs are probably impacting exports at this point. And on the other hand, we do have the GST reforms, which could be a consumption boost.
Yeah, well, exports we are not dealing in outside India businesses much. Our domestic business is almost like 98%. So I don't see any impact for the tariff. And other thing, like you rightly mentioned, so tariff is basically targeting to improve the manufacturing in India, and that will be, I think, helpful for the company as a whole, because we majorly focusing on domestic. And yeah, so I don't see, and the GST, we already under a category of 18%. So tomorrow, supposing they will be rationalize the rates from 18 to 12 or whatever range, and also like goods. So it is hopefully is creating more demand, which is overall countries facing like challenge in the last more than 1 year. So it will be a positive for the overall logistic and express industry more, because with the quick commerce is coming, so more and more shipment is going for their dark storage from the like direct brand to the dark store. And interestingly, that business is also increasing where directly brand sending to customers. So I think with the increase in reduction of GST rates will be certainly help to more consumption in the country, and ultimately we will be ship the more consignments.
Okay, absolutely, Mr. Lal. Thank you so much for joining us this afternoon, giving us an insight in terms of what we should be watching out for from the company going forward in FY26. So that's the management of TCI Express, maintaining the guidance in terms of volume growth, revenue guidance, and targeting an EBITDA margin of 14 to 15%, given that there was a decline last year as well. So on that note, let's hop into a very short break. Don't go anywhere. We'll be back with more news and updates after the break.